You may have $2 million. You also have a pension, and you've been probably wondering, should I do a Roth conversion or not? And we're going to break that down in this video today, and I'm actually going to use a real life case study, which a lot of viewers on this channel ask for, to show you what we did for one of our clients that just moved forward with us. And we're also going to share with you what their advisor told them as far as what they should do, which was totally different than what we recommended them do. So hopefully today's video is very helpful for you, and welcome to Joe Knows Retirement.
Joe knows taxes.
Joe knows the market.
Joe knows Social Security.
Joe knows income planning.
Joe knows pickleball? No.
This is Joe Knows Retirement.
So I want to start off today's video with a reminder to make sure you put down in the comments what you want to hear about, because today's video is specifically about a comment that we received on this point of shared case studies, and we've been hearing this a lot lately, and so we want to make sure we give you all what you're looking for and make sure that you all, if you are an avid viewer, that we can give the best content to you moving forward. And so this is a real life example of a single female who came and saw us. They came and saw us from watching our YouTube channel, and typically what we see when people watch our YouTube channel is they're pretty sharp, they're analytical, and they want to maximize their retirement. They also have a pension, and they also have over $1 million. That's typically the people reaching out to us. And so I always have wondered, like, why do people on YouTube reach out to us that are very sharp, analytical, know their stuff? And of course, it's because who is going to seek for educational content on YouTube that doesn't have that type of personality? And we personally love serving that crowd. We call them a lot of times DIYers or engineers, to have that sharp of a mentality. And we like it because we go really deep with clients, and it's really stimulating to be able to really go deep with clients, but also to be more advanced and not just do cookie cutter decisions like a lot of advisors out there. We really want to get into the weeds of making the best decisions moving forward. And if that is you and you feel like today's video really speaks to you, you feel like, man, this is the exact situation I'm in. I have an advisor, they're not helping me with this, or I'm doing it on my own and I want to seek out help from a team now. I'm tired of doing it on my own. I want to make sure my spouse is good to go if something happens to me. Those are all reasons that we hear people reaching out to us. But if you would like to, there's a description in the link below that you can click on and schedule a time, and just tell them that you found us on our YouTube channel, and we'll be able to schedule a time there to see if we could be a good fit to work together moving forward. And so in today's case study, we're going to talk about that single female I just mentioned who has $2 million saved. She is 63. Her pension is $6,100 a month, so about $72,000 a year is the number we'll use there. House is paid off, has done a phenomenal job, and is still working because they enjoy it, but are looking to retire here very soon. And so they make $170,000 a year, so they're in a great position for making a high income now. And so we really have to think of, are they going to be in a higher or lower income bracket in the future? And looking at their situation with their pension, also they're going to receive Social Security. All of those factors together are probably going to tell us that they're going to be in the same or higher tax bracket in the future. So this is an interesting case because one of the biggest concerns they came to us for is, should I be doing a Roth conversion? And really what sparked the fire for them is they're currently working with an advisor. I'm not going to say who the advisor that they're working with. It was certainly a bigger firm, which we see a lot of people that come and work with us from working with bigger firms who, may charge a fee, but only do investment management. And typically if you ask them, do they do tax planning, or can you help me with this? They'll typically say, we're not tax professionals, go see your CPA. And I'll be the first to tell you, if your advisor's telling you that, you may want to seek out further help, especially if you're paying a generous fee there as well. And so their situation was they were paying 0.6% for their advisor to do the investment management. Now, typically a lower fee than what we typically see for some firms out there. Most firms will charge 1% or more to do investment management. So they were getting a little lesser of a cost there. But then when they evaluated the services they were getting, they were like, well, we're maybe paying less. Like for example, most of our clients in their scenario are going to pay 1%. And so because of that, they're going to be, she's like, well, we're going to have to pay more if she moves over with us. But then she's like, well, I'm only getting one of the 5 pillars right now, and I'm paying more than half. So if I get all 5 for a little more, is it going to make more sense? And so that's what we were able to uncover with her, and that's why she's now a client. But I really wanted to walk through this scenario of, does it make sense to do a Roth conversion? And why was that advisor telling her not to do a Roth conversion, knowing that she's going to be in the same or higher income bracket in the future. And so let's break this down here of what this could look like. And so obviously she's making $170,000 now, so she's going to find herself being single in a bit of a higher tax bracket, but she's still going to have room in the 24% bracket to do a Roth conversion. And so we have to keep that in mind. Now I want us to really think out into the future and project out what is this going to look like for her when she starts to get into retirement and is going to have to be forced to take out money from required minimum distributions from her investments. And that's what we're able to uncover with her and educate her of what does this look like. And so let's do the math. Her pension is going to be $72,000 a year, like we talked about. Her Social Security is going to be about $48,000 a year. It's about $4,000 a month when she decides to take that. And so when you factor in, those two numbers, then that's going to be $120,000 a year of guaranteed income that's never going to go away. So just a little bit less than her current income she's currently getting. And the other thing to think about is the $2 million that she has in investments. Now, she will plan to take from some of those investments during the early years of her retirement. But let's just say that $2 million stayed the same and all the growth, she just took out interest over the years. Well, her RMD is going to be about 4% when she reaches age 73. That's going to be about $80,000 a year she's forced to take out on top of her $120,000 a year. And so because of that, she's going to be taking out $200,000 of income every single year in retirement. And keep in mind, that $200,000 is going to increase every single year ongoing because the RMD percentage withdrawal rate is going to go up as she gets older. And so when she gets into her 90s, she's going to have to take out 8 or 9% from that investment if she lives that long. And that's going to increase the amount of income that she has to take over her retirement. It can be pretty significant over the years of how much that can accumulate to. So my question is why would this advisor tell her not to do a Roth conversion knowing in the future she will be in a higher tax bracket with pretty much, it's a non-negotiable, pretty much inevitable that she'll be in a higher bracket. And so it just doesn't make sense to me that someone would recommend not to do a Roth conversion. Now, I would tell you, I wouldn't recommend converting everything, because if you convert everything, then you're probably going to force yourself into a higher bracket than what they could pay in the future. And the other consideration here is do we really think that tax rates are going to go lower in the future? And I'm not here to argue that they will or they will not, because no one knows. Tax code's written in pencil, but I would rather plan for having a diversification of my investments and not just all my money in tax deferred. I'd rather have some in tax free, some in tax deferred, so that when we do get to those later years, maybe during a 4-year period, tax rates are really high and we're going to pull from the Roth. Or maybe during a 4-year period, tax rates are lower and they do tax cuts, and now we can take from the tax deferred, like something like right now with tax rates historically low right now compared to the past. And so that's a little bit of the understanding of why it could make sense to do a Roth conversion now. So why would this advisor say this though? A lot of advisors just don't really understand the concept of tax planning. A lot of CPAs also don't think of future understanding. They think of past understanding. And a lot of people just aren't really under the understanding of how to plan for this, or maybe they don't have the right software to do it. Now, I know I just made it pretty common sense understanding of why it does make sense. So maybe we can go through some of the objections that we would hear from other advisors who may think this may not be a smart thing to do. So one reason to think about why this could not make sense to do is because of Medicare premiums, right? She's 63, so if she does a large Roth conversion up to the 24% bracket, for example, she's going to force herself to pay more in Medicare premiums when she turns 65. No one likes that. Now, she could likely do an IRMA appeal for 1 year to get that money back for this specific time, because she will be retired at that point, and so that could be an advantageous way that she could get, to not have to pay penalties for 1 year. But if we do this over a few years, then she may not be able to do that every single year, obviously, and that's something we have to factor in. So the thinking becomes behind this is that going to mess up the fact that we should do this? So for us, when we run scenarios for this, sometimes we recommend people paying more in Medicare premiums, other times we don't. It's going to depend on their situation. Now, what you have to think about, though, is does it make sense to pay more in Medicare premiums for maybe 1 year or 2 years or 3 years to have a lifetime of lower Medicare premiums? Maybe because we move a portion over to Roth, moving forward, we're not going to have as much of an RMD that's going to force us over Medicare tiers, and maybe for 10 years we can pay less because we pay more over a 3-year period. And so those are the type of calculations we'd really encourage you to do, or have your advisor do for you, to make sure you're accounting for that. But this is something seriously that you need to take into account, because you don't want to end up paying too much or do too much of a Roth conversion where it forces you to pay too much in Medicare premium tiers or force you in a higher tax bracket that you may not see in the future. And so we want everyone to be aware of this. Another objection that we hear often is, hey, just wait till you retire to do a Roth conversion. And that could be a good strategy. For a lot of people, we do suggest that. Now, in this case study that we're doing, she doesn't know when she's going to retire yet. But also, the 24% bracket for her when we did the analysis was going to be a very low bracket, a reasonable bracket in our opinion, when you factor in all the other income that she'll have later on, knowing that tax rates could potentially go up as well. And so we were willing to do small amounts of Roth conversions while she was working because that 24% bracket is so big. If you're single, it goes up to about $200,000. If you're married filing jointly, it can go up to about $400,000. And you have to factor in the standard deduction as well there, that for a married couple is $30,000 of tax-free income up front. For single, it's about $15,000. And so because of those numbers, we can do some heavy lifting here during those years, whether we're working or we're not, to keep in mind. But also understand that when she does retire, it's not like she's going to have a lower income. She's still going to have a $72,000 pension and a $48,000 Social Security. That's $120,000. Her income's not going to go down that much between now and when she retires. And if she's going to need to take any more income out of her investments, then it's just going to put her very close, if not over, where she was currently before while she was working. And so we have to understand the full picture of what this looks like to make those decisions. Another objection that we hear, and this is actually something the advisor told this client, is, hey, you don't have the money to pay the taxes on a Roth conversion, and because of that, this isn't as beneficial. And that makes zero sense because she's 63 years old. She can withhold money from her tax-deferred investment without any penalty and just pay the taxes out of the investment if she wants to. Now, I don't know why they were saying that, or maybe they didn't understand her situation though, because also she has money in a brokerage account that we could withdraw from and then even have more money go to the Roth as well, and there's no penalty to take out of a brokerage account. You just have to be aware of the capital gains tax that you could pay in selling off specific investments there. And so that's something to really consider as you make that decision. Now, if you are under 59 and a half though, then you do want to be aware of that because you may have to pay a penalty if you withhold money from your investments because you get a 10% penalty there. Now, if you have the money outside, like in a brokerage account like we just talked about, then you could really look into this and make sense. But those are the considerations to really think about if it's going to make sense for you. There's some other more advanced rules like a Rule 55 or 72T that you could look at if you don't have the money outside and still be able to take advantage of Roth conversions if it makes sense for you. And if you do have that pension eventually and that diligent saver who Roth conversions can mostly make sense for as well. And that's another thing I want to touch on is that understand that some advisors out there may not specialize in your area. They may not be used to seeing people with a high income with a pension in retirement and a high net worth with larger RMDs. And so they may not be thinking about everyone else out there. And if you think about everyone else out there, a lot of people out there should not do Roth conversions. We try to educate that a lot on our channel, that if you have no pension, and let's say you have $500,000 or less saved up, you may not ever need to really do any significant Roth conversions because any money you take out from your RMD in the future may be under that standard deduction, and or you could do something called a qualified charitable distribution where you take your RMD or a portion of it and give it to a charity, which is tax-free anyway. So with all those factors in place, you may not even pay any taxes in retirement if you can keep your income under the standard deduction. But if you've been that diligent saver, it's going to be a different set of rules. You're in a unique situation. That's why we talk about the 2% club. 20% of people have pension, 10% have $1 million or more. You're going to need to do different planning than most out there. And a lot of people think that doing a Roth conversion, a lot of advisors even say this, and it drives me crazy because advisors aren't doing the due diligence to understand how this works. But some people think, well, if I do a Roth conversion, I'm not going to have as much money in my account. And that is so false, because if you have $100,000 and you tell me and ask me if that's in an IRA, how much money you truly have, I'm not going to tell you have $100,000. You have $100,000 minus taxes. So you don't, even though your statement shows that doesn't mean that's the value. So if you do a Roth conversion, you have to pay 20% tax. Your statement may show only $80,000, but again, that's after tax. Your $100,000 is not after tax. And so you could simply have the same amount of value, but the advantage is everything's going to grow tax-free moving forward, and you have to look at tax rates as we talked about earlier. It never makes sense to do a Roth conversion if you're going to be, I wouldn't say never, sometimes could still make sense, but most of the time it doesn't make sense. Remember, you shouldn't have absolutes in financial planning. And also, a side note, if an advisor ever tells you you have to do this and gives you a cookie cutter plan and gives you no flexibility or freedom, it's probably not an advisor that's doing comprehensive planning and really considering everything and having a collaborative experience for what you're looking for there. So typically it means it's not going to make sense to do a Roth conversion if you're going to be in a lower tax bracket in the future. But again, as we've kind of went through the math today, most people with a pension million plus, it's going to make sense to do some sort of Roth conversion because of their income. But you got to do the math on your own. You got to run your own numbers to see what makes sense for you. I would say probably about 75 to 85% of our clients are doing Roth conversions right now. But again, we're working with that unique crowd. Whereas I would say that less than 50% of people, or even close to 50% of people, should be doing an actual Roth conversion when you factor in the entire population, because most people pay no income taxes. They're in such a low income bracket where they're under the standard deduction. So just understand how unique your situation is. And another thing to understand for our client situation here is they have one child. So if they pass away tomorrow, they're leaving $2 million that are mostly tax deferred to a child. And so as you know, the new rules for this, they have to take that $2 million out over 10 years. And if they take an equal amount over 10 years, they're going to be left taking $200,000 a year plus any interest that they see in that investment on top of their income they currently have. I mean, they're probably going to end up in a much higher tax bracket in that scenario. And what if they pass away during a time when tax rates are very expedited for their situation? And so that's something that a lot of our clients like to get ahead of so that they can leave them a Roth account, so that they won't have to pay those high income tax bracket scenarios if they can do so now at a lower rate. But be aware, because maybe your child's a teacher making a lesser income, or not making a high income. Well, with your pension in your situation, you may be in a higher tax bracket than them. So that's also something you need to pay attention to, is maybe that it doesn't make sense to do a Roth conversion and pay at a higher rate for you versus them at a lower rate if you just left it to them. And we have clients who have kids in different brackets. One kid's at a higher bracket, the other's at a lower bracket. Well, let's leave the higher amount, the Roth, to the higher income, and a tax deferred to the lower. So you can get really creative on this if you just plan appropriately, and can save thousands of dollars in taxes just through simple tax planning strategies like that when done successfully. But the key is you got to act on it. And so as you can see here, it's all about understanding your specific situation and unique situation. Remember, the other thing I want to mention here, I think this is a great lesson. When paying for financial advice, it's not necessarily how much it costs, it matters the amount of value that you get. We always tell people, we've actually done a video on this of why you should not pay 1% for an advisor, and I stick to that, and I encourage people, it may not worth be paying 1% to an advisor that only does investment management, or that doesn't do the full comprehensive planning. But if you're working with a team that's doing all the value in the world, they're doing all 5 pillars we talk about, they're doing comprehensive planning, they're doing quarterly touch points, they're doing a deep dive into tax planning every year that's really in depth, it's probably going to be worth the cost. And the reasons why, and Vanguard even did a study on this, that even just working with a professional investment management team can increase your returns by 1 to 3% by rebalancing and following market trends and tax efficiency and behavioral finance and all of these things. And then when you factor in all of the other pillars that play a part of that, you can end up with lots of money in savings, hundreds of thousands in tax savings over retirement is typically what we're seeing with clients we work with. And plus all of the just add a return of making all the decisions, not miss anything, making sure that you're accounting for what you may not know or be aware of, can lead to a lot of value over time. And just understand too, if you work with a team like ours or someone else, you are not setting a lifetime commitment for them. So let's say you work with another team and they're not delivering for you. Well, the good news for you is you can go back to doing it on your own, or go back to a different advisor team, or whatever may be most comfortable for you. So that's just one of our biggest encouragements here, is if you're hearing what we're talking about today and you're just feeling you're not confident doing it on your own, we would highly encourage you to seek out help from a team. Make sure you're not missing anything, and don't let the fee be an issue where you don't work with a team if they're truly adding the value. What are you getting versus what is it costing? Now, understand also, this industry is regulated. There's not too many firms that are going to overcharge for services, because we all are registered by either the state or the SEC. So the top 20% of the firms are out there are registered with the SEC, where there's more stricter compliance requirements, there's audits, and then the other 80% is registered with the state. So with us, we're registered with the SEC, and between the, when we used to be registered with the state versus the SEC, there's certainly a little more that needs to be held to, and that they're auditing and making sure is good. So just have that peace of mind too as you search for a team, that that's the case. But there's no necessarily regulation about the amount of services you give someone for that 1%. And so someone could just be getting by for that fee, or someone could be way over delivering for that fee. So just hopefully that's helpful for you as you look for a team there. And if you do want to explore with us, there is a description in the link below. Feel free to schedule time and we can see if we could be a good fit to work together moving forward if you feel like a lot of things on this video resonate with you. So that's all I've got. Again, my name is Joe Schmitz. I'm with Peak Retirement Planning, and we'll hopefully see you on the next episode of Joe Knows Retirement.